let's take a look at Pfizer and calculate the intrinsic stock price of the company. First, we need the market cap 200 billion. The stock price is 36.01. Let's put it down into the model. And now we know the shares outstanding. It's a market cap divided by the stock price gives you shares outstanding 5.5 billion. And the way to calculate the intrinsic stock price is you estimate the future free cash flows of the company. Then you discount that number back to today's dollar amount, and that gives you the value of the company. And then you divide that number by 5.5 billion, and that gives you the intrinsic stock price. And then we'll compare it to the actual stock price to see if the stock is a value or not a value. So let's get the free cash flows. That's in the financial section in Yahoo under cash flows. And free cash flow is the cash that's remaining after you're operating your business each year. So this is a good sign that they have a healthy free cash flow each year. Next, we need net income, and that's the profit or loss for a given time period, and that's on the income statement. And we'll pull that number in. And then last is revenue, and that's just your sales per year. And that's also on the income statement. So you could see the sales are pretty consistent year to year, but the net income is kind of all over the place. It goes from 7 billion to 21 billion down to 10 billion, up to 16 billion, because there's accrual accounting. So there's a lot of non-cash items that go through the income statement, and it makes it a little hard to identify things. Free cash flow is a much better indicator of a company's financial health. And in order to discount the free cash flows, we need to figure out the capital structure of the company. So let's get their interest expense. That's the interest they pay on their debt. It's 1.6 billion. That's on the income statement. And let's see how much debt they have. We'll go to the liability section of the balance sheet. And the current debt is 16 billion. And non-current debt is 36 billion. So the interest payment they pay on the debt is 3%. Interest payments are tax deductible, so let's find out their effective tax rate. And sometimes it's hard to get that off the income statement because of all the depreciation and things like that. So let's go back a few years to look at 2016. That income before tax is 8 billion. And their income tax is 1.1 billion. So the effective tax rate is 13%. So that means the cost of debt is 2.6%. And as you can see, 21% of the capital structure is debt, which isn't too bad, but it is concerning that they have 16 billion. That's like a third of their debt is due within 12 months. So interest rates aren't high now, so it shouldn't be too bad if they roll the debt over. But you generally don't want to have so much debt due in such a short amount of time. Now let's get the cost of equity, and we need the beta for that. And they have a really great beta of 0.65. That's the volatility of the stock. And to calculate the discount rate, it's just a weighted average cost of capital, which is a combination of the cost of debt, 7.3%, and the cost of equity, 2.6%. And that's a discount rate we're going to use to apply to the future cash flows. So we calculated the future free cash flows for 4 years, and we did a terminal value, which is all the years after year 4. And then we discounted those numbers back to today, and we get a value of the company of $250 billion. So when we divide that by 5.5 billion shares, we get a calculated stock price of $45. So it's trading at $36 in the market, so it is trading at a 20% discount. So we do consider this a buy. Interesting to see that it was trading in the 40s for a few months last year, but it's dropped because just because the stock is worth maybe $40, $50 doesn't mean people are willing to pay for it. So in this case, they're not interested in paying $40 or $50. They'll pay $35, $36 for the stock. And that's what happens when a lot of people sell the stock, the price goes down. And So if you feel the future of the company is worth more than $36, you should definitely buy the stock. Identifying the future of a company can be really tricky, and that's really the big challenge. But let's look at some of their ratios to get more of a clearer picture of the company. So I need some more info from the balance sheet. So I just need their current assets and current liabilities. So current assets is 32 billion. And then the current liabilities is 37 billion. And I also need their equity, which is 63 billion. So now that I have 5 really key ratios on the spreadsheet to try to give a better sense of the health of the company. So PE ratio, it might be one of the most common ratios people use. It's the stock price over the earnings per share. And earnings per share is net income over shares outstanding. And I like to invest in companies with a PE of below 15 because I'm a value investor. But sometimes people are willing to invest in companies with high PEs because they're growing companies like Tesla, for instance. But to explain it in layman's terms, a PE of 12 means investors are willing to pay $12 for $1 of profit. So the lower the better. And the great thing about these ratios is you can compare different companies. You should obviously compare companies in the same sector. You don't want to compare Pfizer to Apple because they're totally different businesses. But if you want to compare two businesses in tech or in healthcare, it doesn't matter if one business is generating $1 billion in revenue, other business is generating $1 million in revenue. You compare the ratios because it makes them equal. Now, let's look at the price over sales ratio. This is a common ratio people use when valuing a company that's in a growth mode that might not have a good PE. So they use sales as their indicator, and it's just the stock price over the sales per share. And sales per share is sales over shares outstanding. Sales is the same as revenue. I like to see under 2.2, but if it's a little higher, and as long as I have a low PE, I'm also willing to invest in the company. The big downside of price over sales is that it doesn't take into account earnings. So you might have a great price PS ratio, but your expenses might be really high, so you're not even generating much profit from those sales. So you always want to look at more than just a ratio. There's a lot of things to look at, and it just takes time to understand those. Price over book is also another common ratio. It's the stock price over the book value per share. And book value per share is book value over shares outstanding. And to get that, it's just the equity over the shares outstanding. And equity is pulled from the balance sheet, and it's simply total assets minus total liabilities. That's all the equity is. It's the value of the company. And some people call it net assets or equity or shareholders' equity. It's all the same thing. So the lower the better, generally, but you might have companies with really low price to book, but they could also have a lot of problems on their balance sheets. So it's not always the lowest company is the best. So you have to also keep that in mind. And price to book is also a good thing to look at. If you ever notice these companies that are like the stock price is growing tremendously, you might want to look at their price to book to make sure they're actually valuable. They might not be worth anything according to the balance sheet. Like they might have no assets, hardly any cash. So I wouldn't want to invest in a company that had a really weak balance sheet. Just because its stock price is going up doesn't necessarily mean it's a strong company. Current ratio is also another popular ratio. It's current assets over current liabilities. And current assets are assets that can be liquidated into cash within 12 months. or less. And current liabilities are what you owe, and that all that is due is within 12 months. So I like to see between 1.2 and 2. Under 1 is very concerning because that means, in this case, Pfizer under 1, and that means they don't have enough liquid assets to cover its short-term liabilities because they have, as we saw, a lot of debt that's due within 12 months of 16 billion. And if we go to the balance sheet, they have 4.5 billion of accounts payable, so they owe other businesses $4.5 billion. There's 12.5 billion of other, and we can look at a 10K for that, but we won't have time for this video. So I'd be concerned if this was a small company, because if it was a small company, they might not be able to like raise funding in order to pay its debt or to pay its vendors. But in a case like Pfizer, they're such a big company, and I think they can handle. And another thing to remember is that you can't look at just a metric in one time frame. You have to look at it over a longer period of time, because certain companies are cyclical. So they might have a current ratio of like 0.6 one quarter, and you might be like going out of business. But then the next quarter they have a current ratio of 2, because it's timing of a lot of things. So you have to look at it over a longer period of time and always compare to similar companies in the industry. And ROE is another good one. And I like to see above 20% on ROE. And that's just net income, which we input earlier, over equity, which is from the balance sheet. And we generally want to see a higher the better, because it like the word ROE means return on equity. It's the return you're providing to your equity holders. So a higher ROE means the company's efficient in generating income from its equity financing, because it sold stock, right? And that stock, they got the money for that stock, so that's what the financing is. And what they do with the money from that stock is what we want to know, and we want them to do as much as they can to grow the business and make it profitable. So not only does the stock price go up, but the company's around for a long time. And the average ROE for the entire stock market is 13%. So this is double. That doesn't mean it's great. You want to compare it to other companies in the industry, because some industries have really, really high ROEs and other industries have really low ROEs. That's just the nature of that particular industry. So thanks for watching the video, and let me know in the comments if you want me to do another video of a different company, and let me know if there's other ratios you want me to add, or if you prefer without ratios. I just started doing the ratios in the video, and I think it's helpful.